Finally, managers who are within reach of the bonus cap have incentives not to exceed the cap because they get no rewards beyond that point. And these perverse incentives are even stronger if the year's performance is used in setting next year's targets. In this situation, managers have incentives to move expenses from future to present, revenues from present to the future to avoid exceeding the bonus cap this year, to increase bonuses in future years. And again, managers have incentives to do this even if it imposes real costs on the company. Suffice it to say, maybe two. That all the behavior described above is a violation of word 4 and is therefore out of integrity and leads to unworkability and value destruction. And note that all this destructive behavior by human beings in the organization is motivated by the fact that this common bonus plan is out of integrity in its design as a system, eliminating the counterproductive behavior must start by eliminating the lack of integrity in the design of the compensation system. Asking the human beings operating in this badly designed system to change their behavior will fail unless and until the compensation system itself is redesigned and to put it into integrity. Popular recommendations to solve these incentive problems in the banking and financial industry as a whole tend to focus on eliminating bonuses, often motivated by perception that the way the bonus plan works leaves top people paid too much rather than the bonus rewards people in the wrong way and for the wrong things. This approach addresses nothing about the design of these plans and ignores the potentially huge damaging effects associated with a mass exodus of highly qualified people from the banking and financial industry. Further evidence on management, manipulation, and earnings. Evidence from a survey of 401 CFOs reveals a fundamental lack of integrity. Graham Harvey and Rajgopal's survey of the 401 CFOs find that 78% of the survey's executed executives are willing to knowingly sacrifice value to smooth earnings. While it seems that recent scandals have made CFOs less willing to use accounting manipulations to manage earnings, this survey indicates that to meet short-term run earnings targets, CFOs are willing to change the real operating decisions of the firm and thereby destroy long-run value. When smoothing earnings, it is true that the CFO could maintain his or her integrity, their word, and their firm's word being whole, complete, etc., by making something like the following public announcement each time they make such value destroying decisions. Given how I am paid, I am rejecting or delaying a firm value increasing project in order to meet analysts' consensus earnings forecast so as to increase my own pay. We would guess that relatively few CEOs and CFOs would actually make such announcements to their board of directors, analysts, and to the public. Aggregate evidence on the manipulation of corporate earnings. Figure 3 displays the aggregate evidence from the George Patel and Zeckhauser 1999, page 20, study of the errors measured in cents per share of corporate earnings between actual earnings and analyst consensus earnings forecast for over 100,000 quarterly observations on over 5,000 firms in the 1974 to 1996 period. This distribution is not symmetrically distributed around zero. In fact, there are far too many observations that at exactly zero, as indicated by the center tall bar. It is interesting that lost from view in figure 1 is that the stock price response from hitting exactly zero, exactly hitting expectations, is significantly negative and lower than the response for missing expectations by, say, 0.01%. The explanation seems to be that zeros are most likely the result of CEOs manipulating earnings toward upward to get exactly to zero, and the market understands that and sees it as negative information, aggregate evidence on manipulation of earnings. Share of corporate earnings for over 100,000 quarterly observations on over 5,000 firms, 1974 to 96 period. This distribution is not symmetrically distributed around zero. There are far too many observations. Uh, as indicated at the center tall bar. The black areas below the x-axis denote the deficiency and infrequency of observations in the intervals of the distribution that would be expected if the true underlying distribution were symmetrical around zero. There are far too many observations in the intervals between -4 cents per share and -1 cent per share, where firms have missed analyst consensus earnings forecasts by a small amount, and far too few observations in the intervals greater than +4 cents per share, where firms significantly exceeded the analyst forecasts. Indeed, the black areas below the x-axis denote the deficiency in the frequency observations in the intervals of the distribution that would be expected if the true underlying distribution were symmetrical around zero. There are far too many observations in the intervals of -4 cents to -1 cent, where firms missed analyst consensus. The amount of far too many observations, greater +4 per share cents per share, were firms significantly exceeded analyst forecasts. These results are consistent with the hypothesis that the management is manipulating earnings to show far too many instances of quarterly earnings reports that exactly meet or just beat analysts' expected earnings, and far too few instances of quarterly earnings reports of -1 and -4 cents below analysts' expected earnings. This accomplished by reporting lower than actual earnings when earnings would be substantially above analysts' expectations, and storing the hidden earnings so that the firm could report just meeting or beating analysts' expectations when the firm's earnings actually would have come in below those expectations. And the manipulation of earnings extends to the reporting of hedge fund returns. It appears that hedge funds regularly report smooth month-to-month returns that apparently results from the fact that being able to say we have only had X months of negative returns, X being the very small number, has a big impact on attracting investors to the fund. This means that reporting a return of plus 0.01% rather than negative 0.01% in any month leads to a large advantage in recruiting and retaining investors. And consistent with this, the evidence that indicates that the distribution of returns for hard to value hedge funds shows too many monthly returns just above zero and way too few just below zero. This is consistent with the hypothesis that hedge funds systematically underprice the value of the fund during the year so that they can smooth out returns from month to month and avoid reporting negative returns in any month. Consistent with this hypothesis that hedge funds manipulate the month-to-month value of their funds to serve with their own interest in contractual features of hedge funds provide some strong incentives to inflate returns in December each year. Whoa. Okay, so and the evidence indicates they do so. Hedge funds earn incentive fees if they beat their contractual benchmarks and better performance, increasing investors' contributions to the fund. Agarwal, Daniel, and Naik 2010 provide strong evidence documenting this phenomenon. They find that the average December return is more than twice as high as the average returns for the entire 11 months, January through November. In author's words, in this paper, we provide strong evidence of hedge funds inflating their returns in an opportunistic fashion to increase their compensation. Specifically, we find funds that stand to gain from most from good performance, the funds that stand to lose the most from poor performance, and the funds that have greater opportunities to engage in return inflation exhibit the greatest spike in December returns. We also provide evidence on two potential mechanisms employed by hedge funds to manage returns. The first method involves funds underreporting their returns in the early part of the year in order to create reserves for possible poor performance later in the year, saving for a rainy day. In case some of these reserves are left unutilized, they get added to the December returns, resulting in the spike. The second mechanism involves funds borrowing from their January returns of the subsequent year to improve their December returns. This can be achieved by funds pushing the security prices at December end by last minute buying, which is followed by price reversals in January, page 37. And this violation of word for the other would find the evidence for my assertion also the valid for themselves extends to the reporting of the analyst recommendations. Ludwig Malloy and Marston, 2007, in the paper Rewriting History, study the major historical database of the financial analyst stock recommendations and find substantial evidence that the historical record as reported in the widely used IBES database produced by Thomson Financial does not represent the recommendations that were actually made by the analysts. They conclude, comparing two snapshots of the entire historical IBES database of research analyst stock recommendations taken 2002 to 4, but each covering the same time from 1993 to 2002, we identify tens of thousands of changes which collectively call into question the principle of replicability of empirical research. The changes are four types. One, the non-random removal of 19,904 analyst names from historic recommendations, anonymizations. Two, the addition of 19,204 new records that were not previously part of the database. Three, the removal of 4,923 records that had been in the data, and four, alterations of 10,698 historical recommendation levels. In total, we document 54,729 ex post changes to a database originally containing 280,463 observations. I've been skipping these notes. We apologize to the reader for the long quotations summarizing this study results rather than simply summarizing them. Thompson has been quite litigious regarding the issues researched and discussed by Lundqvist. As of February 2007, Thompson Financial's position is that changes to recommendation history have occurred as part of necessary processes and maintenance. Previously, Thompson had indicated that the anonymizations were the result of three software glitches. First, produced incorrect start and end dates for some analyst employment histories. For second, caused selective ticker histories for certain analysts to be anonymized in connection in attempts to consolidate duplicate analyst identifiers. The third, which can still occur, results in recommendations being attributed to an analyst who has departed. Subsequent corrections involved anonymizing such recommendations. Lundquist, Malloy, and Marston, 2007, continue. At the recommendation level, the collective effect of the changes is to make the overall distribution of historic recommendations issued for U.S. companies between 93 October and July 2002 appear more conservative in 2004 than they did in 2002, with considerably fewer strong buys and more holds, sells, and strong sells. Broker level data, which can be used to predict profitability of stock recommendations, Barber et al. 2006, change more dramatically. One reason for these findings are important is that the apparently optimistic bias in the historical distribution of recommendations was a frequently cited impetus to the regulatory proceedings that culminated in the global research analysts settlement of 2003 between New York Attorney General Elliot Spitzer and the SEC, NASD, NYSE, North American Securities Administrators Association, state regulators, and 12 brokerage firms. Wow. Similarly, the changes impact the implementation of popular trading strategies based on analyst consensus recommendations. A simple trading strategy that buys stocks in the top consensus change quintile and short stocks in the lowest quintile each month performs 15.9% to 42.4% better on the 2004 tape than on the 2002 tape, suggesting that these changes to the IBES database have resulted in the appearance of more profitable analyst research. Track records of the individual analysts are also affected among the group of analysts with the anonymized recommendations. We find the abnormal returns following subsequently anonymized upgrades to buy are significantly lower than our abnormal returns following upgrades. By the same analysts that remained untouched, the return differential is large, ranging from 3.6 to 4.0 PA over the 1993 to 2002 period. It is even larger in the most recent post-bubble period, as high as 7.4% PA, and for the subsample Boulder recommendations 5.2% and 9.1% PA in the full sample and post-bubble periods respectively. Analysts who track records are associated with more favorable career outcomes over 2003 to 5 period than their track records and abilities would otherwise warrant. Following the career path modeling of Hong, Kubik, and Solomon 2000 closely, we find that analysts associated with the anonymizations experience a more than 60% increase in their likelihood of subsequently moving from a low status to a high status brokerage firm. This effect is much larger than any other in our career outcome models. The magnitude of the effect of additions on career outcomes is also large, boosting the likelihood by more than 40%. Similarly, analysts are more likely to be rated the top stock picker in their sectors by the Wall Street Journal, which relies on the Thomson financial data, if some of their recommendations have been dropped or added. Collectively, our findings raise serious doubts about the replicability of past, current, and future studies using IBES historical recommendation database. Will continue on conclusion between analysts and firms.